Hello everyone, I'm Shekhar from Momentum Lab. Now, so far we have seen different factors and their performances over the last 20 years. During this analysis, we also observed that factors do not have consistent outperformance all through across. They have their own cycle of underperformance and then again overperformance. Now, if this is the case, then the logical question arises that can we benefit in somehow from this cyclicality of factors? That is, can we time the factors in such a way that we're going to pick those factors which are showing strength or outperformance and exit from the factors which are not showing strength or outperformance? Simply put it this way, we'll be doing a momentum strategy on different factors and see if the resultant strategy is better than the individual factors or not. So that's the whole purpose of this video. Now, in this video, I'm going to divide it into four parts. The next part will be on the strategy definition of how am I going to construct this strategy, what will be the constituents of the universe, what are the ranks, how will we sort them, how will we exit them, when will we rebalance. I'll be describing in detail about the strategy. In the second part, I'll be showing the sources from where we get the raw data and how we transform this raw data so that it is easy for us to do the calculations. And thirdly, I'll be doing the actual calculation of showing how the momentum strategy can be applied in Google Sheets. Someone who's interested to know how these backtesting can be done can watch this part. And lastly, we'll be directly delving into the analysis part. Now, in the analysis part, I'll be presenting the final output of whether the strategy is better than the individual constituent factors or not. So someone who's only interested in the analysis part can directly skip to the analysis part. So let's begin the video. So let's see the strategy first. Now, to define a strategy, first we need to have the universe set. Now, I've chosen the universe as Nifty 200 because within the Nifty 200 universe, you have all the five different factors that are available. Now, you can ask, like, why are we considering the factors within a particular universe? Because I don't want to insert a new variable to the problem. For example, imagine, let's say I'm picking Nifty 500 momentum 50, Nifty 200 value 30, Nifty mid small cap quality. So then what we're doing is we're actually not only comparing factors, but we're also comparing factors across different sizes, small cap, mid cap, large cap, and all universe. So to eliminate the bias of the size, what I'm going to do is I'm going to take one universe, Nifty 200, and within the Nifty 200, I'm going to pick all the factors which are available. That's the major reason. And secondly, the other reason is that even in the NSE website, we don't find the data for other strategy indices, like let's say that if you go to Nifty 500, in Nifty 500, we have Nifty 500 momentum 50, we have Nifty 500 value 50, but Nifty 500 quality is missing, low wall is missing, and alpha was also missing. That's the reason I chose Nifty 200 universe, because Nifty 200 has Nifty 200 alpha 30, and we also have Nifty 200 momentum 30. We have Nifty 200 value 30. We also have Nifty 200 quality 30. The only missing piece is Nifty 200 low wall 30. So for that, I have chosen Nifty 100 low wall 30, which is again a subset within the Nifty 200 range, Nifty 100 low wall 30. So that is the basis for choosing the universe of five factors. Now, I'll run a momentum strategy on these five factors and compare its performance against the benchmark Nifty 200. So that's what I'm going to do. Now, in these among these five factors that I have, now we can calculate the momentum. Now we're doing a very simple momentum calculation. We'll take last 1 year or 12 months, last 12 months returns of these five factors and compare among these five factors of the last 12 months and pick the top two factors based on the last 12-month returns. So every month, the first of the month, we'll pick top two factors based on the last 12-month returns, and we are going to hold them for 1 month. On the next month, when we do a rebalance, we're going to do the same exercise of calculating the last 12-month returns and see if these two existing factors are still among the top two or not. If they're among the top two, we'll continue to hold them for another 1 month. If any one of these factor is not among these top two, then we're going to exit that and pick a new factor which is among the top two. So that is a simple strategy. Now with this strategy, let's go and see how we can get the raw data. So first, I'll be going to the niftyindices.com. This is the official portal of Nifty, and where we can get all the indices data. You can go below to the report section and click on historical data. Select the total return index instead of the historical index data, because total return index will also include the dividends and any stock split or bonus, that whatever happens, it is all covered in the total return index. You select equity, and then from here you select an index of your choice. You can click, let's say we first want to start with Nifty 200 value 30, and you select the time period. I'm going to select from 2005 onwards, 2005 August 1st till today, and then I'm going to download this data. Now this exercise I've already done, and I've already kept all the data ready in this Google Sheet. If someone wants to directly access this data, it is already available in Google Sheet, so that you don't have to repeat the exercise again of calculating it. I'll be maintaining this sheet on a regular basis. So as on end of every month, I'll be updating, appending the data. Right now, it is still end of August. By end of September, I'll again append this data. So this data is already available for us. So I'll show how the data looks like. So when you pull the data, you actually see only these columns. When you pull the historical data, let me click and show you. So you'll only be seeing the date, the total return index, and you'll also see the column, whether it is Nifty 200 value 30. So you'll get the raw data in this fashion. So you'll see the index name, you'll see the date, and you'll see the total return index. So whatever data that I've calculated from this column D onwards are derived metrics, basically from this data that is available. So same way I've done for Nifty 200 momentum 30, value, alpha, low vol, and quality. Now with this, what I'm going to do is I'm going to put all the data in one single sheet. So in this sheet, I have the dates starting from August 1st, 2005 on a daily fashion. And I have momentum's data, value, quality, alpha, low vol. I've also included Nifty 200. Now you can see that all of them are indexed or normalized to 100 starting 1st of August. And from there onwards, we are calculating, or we are pulling this data. Now, how do you do normalization? To do normalization, what I usually do is we'll calculate the daily change for each index, calculate the daily movement, like that is the today's value or the current day's value subtracted by previous day's value divided by the previous day. So this way you'll get the daily change. Then what I'll do is, to normalize this, I'll start the first data point as 100 and multiply the subsequent days NAV by the previous day's NAV, which is 100, multiplied by the daily change. The daily change is this value. So this way you get a normalized or standardized values of each factors. Now, once we have normalized data starting from 100 from 1st of August, this is the raw data that we have. Now I'm going to transform this or roll up this data into a monthly fashion, because I don't want to do rebalance every on a daily basis or on a weekly basis, but in fact, I want to do the rebalancing on a monthly basis. Since we do not have the data on a monthly level, we have to roll that up. So to roll that data, what I'm going to do is I'm first going to use a function called equal to month. When I select equal to month and give the date, then I'm going to get the count of that month. If let's say it is August, I'm going to get it as 8. If it is September, I'm going to get this as 9th. Now, the use case for getting this month is we'll be able to identify whenever there is a month change happening. So let's see what is the formula that I use. So I'm going to use a formula called as equal to if B2 is not the same as B3, then print A2. If not, print blank. Now what it does is it checks, and I'll drag this all the way down. It checks if the tomorrow's date, or if the tomorrow's date is the same as today's date, then it doesn't print anything. If the tomorrow's date is different from the today's date, then it is going to print the current day's date. Now this way, we're going to get the last date of each month. Now, when we get the last date of each month, then what I'm going to do is I'm going to remove the blanks, and I'm going to get the rolled up data. Now you can see I have the rolled up data end of the month for each factor as well as for the index Nifty 200. Now this is the transformation that I do. And then once we have this transformation, then I'm going to use or pull it in the raw data file. This is the raw data file, which has data for monthly. Again, I'm going to share this Google Sheet. If someone is interested, they can, or he or she can take a look at it, take a look at the formulas and get a hang of it. Now, once I have the monthly level data of all the factors, then I'm going to calculate the monthly change. Monthly change is nothing but the current month subtracted by previous month divided by the previous month. So this way I'm going to get the monthly change for all the factors. Then I'm going to calculate the 1-year return or 12-month return for each factor. Remember, we are using 12-month returns as the basis for our momentum strategy calculation, and hence I need the 12-month return. So to do that, since we have started from 31st July 2005, the 1 year will end on 31st July 2006. So I'm going to calculate the returns as on 31st July 2006 minus 31st July 2005 minus 1. So this way it will give me the 12-month return. Now, once I have 12-month return, I'll calculate for all the factors and drag all the way down. Now I have all the factors. I have all the factors 12-month returns. Now the time has come for me to rank these factors based on their last 1-year returns. Now observe this column, this cell Q15 for momentum. Now what I'm going to do is I'm going to rank the 1-year return of momentum compared to the other factors 1-year return. So I'm going to use a function equal to rank. I'll select this cell L15, which is momentum's rank, comma L15 to P15. This is the range that I'm interested in. And I'm going to freeze L to P, which is basically this is the range that I'm interested in. And when I drag it down, I'll always get the current month's rank. Now, by doing this function, I get the values in the descending order, meaning the factor which has the best or the topmost 1-year returns. Let's say in this case, it is low vol as on 31st July 2006. That is rank 1. And value, which has only 5.9% as its last 12-month return, is rank 5. And similarly, I get the ranks for other 3 factors. So this way, I have ranks for all the factors for all the months. The next thing that I need to do is I need to pick the top 2 among these 5 different factors for me to invest. So what I'm going to do, I'm going to use a simple hack where I'm going to highlight only those factors whose ranks value is less than 3. Meaning if I have a factor whose rank is either 1 or 2, I want to indicate it separately in a binary fashion of 1. If the ranks of any of the factors are not less than 3, meaning either 3 or 4 or 5, I want to show them in a binary fashion of 0, so that I know which ones are the factors to invest and which ones are the factors not to invest. So I'm again segregating in the simpler binary fashion of 1s and 0. Now for that, what I'm going to do is I'm going to use a simple if function equal to if this cell, if this cell's value is less than 3, print 1, else 0. I'm going to drag all the way from B to Z so that I know which ones are the factors I'm going to invest on. Now for as on 31st July 2006, I noticed that momentum and low vol are the factors that I'm interested in investing. Now, if I drag this all the way down, I'll get the factor rotation of top 2. So this way you can see how is the factor rotation or happening between different factors over the period of time, all the way from 2006 till 2024. Now we have understood so far the how are we calculating the 1-year returns, and based on 1-year returns, we have seen how are we calculating the rank from 1 year from the ranks, then we are calculating the picks. Now, once we have identified the picks, now we have to allocate equally among the picks that we have chosen. So if wherever there is 1, we have to give some weightage. Wherever there is 0, we should not give any weightage. Now, in my strategy, since I've said that we're going to pick the top 2 and we're going to allocate equally among these 2. So there's a 50-50 weightage. So it doesn't matter whether we, even if the rank 1, let's say, is low vol and rank 2 is momentum, for us, while investing, both are equal. And we give 50-50 weightage to momentum and equal and low vol. Now, to do that, the formula that I'm going to use is equal to P15. That is, if any factor, if it is having the binary value, that value divided by the summation of all these values. And since you know that when we sum all these, it will always be equal to 2 because we're only picking top 2. So if this binary value is 1, then we always get a fraction 1 by 2. If the binary value is 0, we'll always get a fraction 0 by 2, which is 0. So this way, we are able to convert this picks into a weightage format. This is the final transformation where we are able to come from the absolute returns of 1 year to rank, from rank to picks, from picks to weightage. Now this way we know which index to allocate which weightage. Then finally, our end objective is to calculate the strategy's NAV. Let's say we are starting as on 31st July 2006 and we are allocating 100 rupees for the strategy. Now, when I'm allocating 100 rupees as on 31st July 2006, I need to see which are the 2 factors that I'm going to invest. For me, the signal has been for low vol and momentum, and I decided to invest 50-50 equally between momentum and low vol. Now, to get the next month's NAV, I need to calculate the returns that I got for the next month, which is the entire August month. After I invested from 31st July 2006, I need to calculate the entire returns as of August to fetch the final closing NAV as on 31st August 2006. Now, if I have to get the returns for the August month for low vol and for momentum, instead of manually calculating every factor one by one, what I'm going to do is I'm going to use a sum product function. Let's see how this sum product function works. Now, the sum product I'm going to do for the previous month's weightage multiplied by the current month's monthly returns. So I'm going to take the signal of previous month's weightage and do a sum product and multiply the current month's returns. This way, I'm going to and add 1 to it. And when I add 1 to it, I get the delta change from the previous month to current month. Now, when I multiply that with the previous month NAV, I'm going to get the current month NAV. Now, once I drag all the way down, I'm going to get the strategy's NAV. Now, this is how we backtest multi-factor momentum strategy. Now, this Excel or calculation that I've shown can be useful for us to do a multi asset or whenever we have more than 3 or more than 4 assets or sectors or stocks. And if you want to run a momentum strategy on more than multiple stocks or assets or securities, then this is the simplest way to do momentum ranking. Now, let's say if you want to change the logic also, let's say if you don't want to pick the top 2, you only want to pick the top 1, you can still do that. How can you do that? You just go here and change the calculation. Instead of picking the stocks which are having rank of, instead of picking the factors which are having the ranks less than 3, you can simply say less than 2. So that way, if you say less than 2, you're always only going to get the factors which are only 1. And if you drag this all the way down, you're only going to get the factors which are topmost ranked. Now, let's say if you want to change it, and if you want to have top 3 factors, you can do that also. You can just simply change this to top 4, and you're going to get the picks which are in the top three. So when you see that you're having momentum, alpha, and low vol. So this way you can change whatever number of picks you want to have based on momentum, whether you want top one, top two, or top three. Now notice that whenever you want to change the logic of instead of having top two, let's say to top three, then what happens is that I said you can change this uh, if function from less than 3 to less than 4. Automatically you will be seeing that all the top three ranked strategies will start to show in green color with 1. And when they show in green color with 1, the binary, and the remaining bottom 4 and 5 will show in 0, the weightages automatically get changed to 33, 33, 33, equiveightage. So that's how this strategy's NAV can be easily or quickly changed. So now let's stick back to the top two only and see what are the final values looking like. All right. Now this is the final value that we have of the strategy's NAV. Now we need to compare the strategy's NAV with the respective constituents, that is momentum, alpha, low vol, quality, and value. Now you can see that we are starting the strategy's NAV from 31st July 2006 onwards. Now if I have to compare, I have to compare with the NAVs of momentum, value, quality, alpha, low vol starting from 31st July 2006. And you see, since we have started from 31st July 2005, the values are not indexed to 100 as on 31st July 2006. So we again have to normalize this to get back these factors values to 100 as on 31st July 2006 and again do the calculation. So for that, we'll again do the normalization and get this final value. So you can see this. So we have done the normalization to get the factors momentum, value, quality, alpha, and low vol to 100 starting from 31st July 2006. Now, once this normalization is done, we also added the strategy beside it to do a like-to-like comparison. Now, let me select all of these and let's also select the date and insert a chart to see how the performance is looking like. So I'll put a smooth line chart. I'll add the date column here and I'll remove the date from here. Now this is how it looks like. So as you can see, the strategy is in the magenta color and it closely resembles the momentum. The blue color one is momentum. Apart from momentum and strategy, rest all are somewhere in the bottom. Now, this is not a great way to visualize because this is not logarithmic. You'll only see the recent changes more pronounced. Let's do a logarithmic change and see how it looks like over a period of time. Let's start the minimum value at 80. Okay, let's do it at 70, maybe. 50 looks better, yeah. Cool. Now this is the logarithmic function. It looks muddled, but I'll try to explain one by one so that we can focus on one factor at a time. So the factor or the strategy that we're interested is this one, final strategy. So let's work on that. So this strategy has clearly shown to outperform value in the recent times. And it has also outperformed quality. And it has also outperformed low vol. But it is neck and neck with momentum at this point of time. And if we go back and if we see, there was value outperforming the strategy. Now, this is not a great way to visualize. So what I'm going to do is I'm going to transform this into rolling returns. Now, once we have rolling returns across 3-year, 5-year, and 7-year, then it becomes a scientific way to see whether the strategy outperforms the individual factors. The issue with this is it is point-to-point based. And in the point-to-point based, we can have the starting point and the ending point bias. So I've already done that, rolling returns of 3-year, 5-year, and 7-year. You can check this Google Sheet for the raw data. And once I have done the 3-year, 5-year, 7-year, I've also gone ahead and calculated the drawdowns for each of these factors as well as the strategy. So let's finally look at the summary. I'm going to zoom in a bit and show the final summary, how it looks like. This is Nifty 200. This is momentum. This is value, low vol, alpha, quality, and finally we have factor rotation of top two. Now we have 3-year rolling returns, we have 5-year rolling returns, and we have 7-year rolling returns. We have max drawdown and we have volatility. One more thing that we need to take into consideration is that for each of these factors as well as Nifty 200, there is no transaction charges. There might be minimal transaction charges because all of these are buy and hold. The only strategy, which is factor rotation of top two, we'll see churn because we're going to purchase some new factors every month and we're going to sell them. So if you count the number of transactions that we did over the last 18 years during this analysis, since we started from 2006 onwards, we saw there were total number of 60 unique transactions that have happened, meaning roughly around three transactions in a year. So every 4 months, some change happens in our strategy. So straight away, there is a transaction cost dependency which will further erode the returns. So let's be absolutely clear that this strategy, whatever numbers that we are seeing, in reality, this might be even less. So that's the first point. The second point that I want to communicate is that we are doing all this analysis on the indices, not on actual tradable instruments. Now, these indices, there are no, in fact, actual tradable instruments, whether in the form of ETF or mutual fund, since 2006. In fact, most of these indices, factor indices, have been created very recently. And even recently, also, even after creating, we are having these factor indices. Based on these factor indices, some ETFs or mutual fund launched just in the last 1 or 2 years. So this exercise is only for academic purpose, just to understand whether there is a merit or not. If we find some alpha, if we find some merit in this strategy at a higher level, then we're going to double down and see whether it has any practical sense or not. So at a theoretical level itself, if there is no merit, then we'll not even go or bother think about doing any practical implementation related issues. So with that caveat being established, now let us look at the rolling returns. First of all, you see that the rolling returns of the factor rotation of top two, whether be it 3-year, 5-year, or 7-year, is no way better than alpha or momentum. Momentum and alpha are way ahead above the factor rotation strategy. You see at 3-year, it is 19.69 for momentum, 19.49 at alpha for alpha versus 17.46 for factor rotation. For 5-year, it is 18.93 for momentum. For alpha, it is 18.25, 5-year rolling returns. And for the factor rotation of top two, it is 16.75. Same is the case with 7-year. Momentum and alpha are around 19.65 and 19.68, whereas for factor rotation, it is 16.5. Yes, the factor rotation of top two definitely beats the Nifty 200 buy and hold. But it doesn't beat some of the buy and hold of factors like momentum and alpha. It gives tough competition to quality, but we'll have to bear in mind that if we remove the transaction cost, then it might not be as good as quality also. So the only two factors it beats are value and low vol, and it also beats Nifty 200. So the summary that I have is it is futile to run a momentum strategy on different factors. Instead, it is better to stick on some of the existing known factors like momentum or alpha. Even better if you can, if you want to protect something on the volatility side or on the drawdown side, it is better to combine with either low vol or quality or value with either momentum or alpha and generate a better factor strategy. Now, if you look at this factor rotation of top two strategy, it is not good in terms of return wise. It is also not great in drawdown and volatility sense also. On drawdown, it is almost equal to momentum. It is better than alpha, but it is not as great as momentum or Nifty 200, in fact, the benchmark. And even in the volatility sense, it is almost similar to momentum and Nifty 200. So all in all, it doesn't make a great case for running factor based momentum or timing the factors. So that's a clear avoid based on this data.